Superstars. This is Professor Don Bush. I've been a professor for about 30 years now and a CPA for about that long, so I've got great ways to explain accounting. And if you want to learn accounting, you've come to the right place. Today's lesson is it's designed for people that are in about their third, fourth, fifth week of class and studying adjusting entries. And adjusting entries are a little tricky when you're first starting out. And so I've got some good ways to explain it. Today's lesson is about unearned revenue. Hey, but first, before we get started, I just set up a web page. It's called accountingsuperstars.com, and it's got all these videos. I think this is video number 87 here. And I've got these videos organized on this web page, so that way you can look them up by topic. It'll make it a lot easier for you. That's accountingsuperstars.com. Check out the page. Also, if these videos help you out, hit the like button, hit the subscribe button. That way YouTube will show these videos to other people too. All right, so here's what's going on, folks, is that we've got when we get to a construction, and a customer paid when we get to a construction $10,000 in advance to do a job for them. And throughout the year, they did in fact do most of the job. They didn't get it all done, but out of that $10,000 advance payment, when we get to a construction, earned $8,000. So here's what they did: is when they first received the money, they credited unearned revenue because they knew better. They knew that in order to claim revenue, you got to do your job. Well, they knew that they hadn't done their job yet. They got paid in advance, so they called it unearned revenue. Now, unearned revenue is a liability. That means that when we get to construction, owes these people some work, all right? It's a liability. It's an obligation. Now, at the end of the year, though, they have earned $8,000. So that unearned revenue, most of it has been earned. So here's what we're going to do. And here's a couple little T accounts here to show it. So here's our unearned revenue right at the very beginning of the year. And it turns out that they earned $8,000. So let's do this. Let's put $8,000 right here. And that'll bring that unearned revenue balance down to $2,000. Okay, so that account's all straightened out. Now, over here in this pink colored box, this is construction revenue. And throughout the year, they've earned a lot of revenue. And that $50,000 does not include the $8,000 that they just earned. So let's include it. Here we go, $8,000. And that brings the grand total to $58,000. So here's what we're doing, is we're debiting one account and crediting another. In other words, we're essentially taking this $8,000 and calling it, moving it from unearned to earned revenue, construction revenue. They did their work, they did their job, they can claim it as revenue. So what's the journal entry? Well, here's the journal entry that will that the accountant will put in the books. And here's what it is unearned revenue is being debited by $8,000, which is what happened in the T account. And revenue is being credited for $8,000, which is what happened in the T account. So really, this journal entry is just a reflection of what's going on here and vice versa. So coming down here, now here's a small little chart here, guys. And years ago, accountants used to use these charts all the time to help them figure out these adjusting entries. And in school, we really don't teach this much anymore, if at all. And I'm not sure how much accountants use these anymore. I used to use them a lot when I did accounting, but that was back in the old days. So here's what we're doing, folks. This chart here is just a little tiny piece of a giant worksheet. We've got unearned revenue, accredited $10,000, which comes from right there. And we've got construction revenue of $50,000, which comes from right here. So this adjusting entry, it's in this green box here, and I made this green too to show that the two relate. Unearned revenue is being debited for $8,000. There we go, $8,000. And a credit of 10 and a debit of 8, that means you still have a credit of 2. There you go. And then you've got to decide, well, unearned revenue, does it go on the income statement or the balance sheet? And hopefully by now, and I've brought this up over and over in these videos, that only at this point in your education, only two things go on the income statement: revenues and expenses. That is it. Nothing else. No cash, no accounts payable, nothing else, only revenues and expenses. Now, unearned revenue is a liability, so it's not a revenue or an expense. So it's going to go on the balance sheet here, on the balance sheet as a credit. And how did I know it's a credit? Well, because it's a credit on the adjusted trial balance. We're just moving it over to where it belongs on the balance sheet. What kind of things go on the balance sheet? Assets, liabilities, and equity. So it's found its home here on the balance sheet. Now, construction revenue, we've got a credit of $50,000, and according to our adjusting entry, we're crediting it again for $8,000. Okay, so a credit of 50 and a credit of 8 gives you a credit of 58. Okay, easy. And then you have to decide, well, where does it go? Does it go on the income statement or balance sheet? Two things go on the income statement: revenues and expenses. That's it. And construction revenue is a revenue. All right, so it's going to go on the income statement. There we are. Now, you might say, gosh, I'm not seeing how this little worksheet thing balances. Debits don't seem to equal credits. And we're only seeing just a portion of this little worksheet, so that's okay. Hey, well, folks, if this lesson helped you out, let me know. Hit that like button, hit the subscribe button. Check out accountingsuperstars.com if you want to look up other videos to watch to help you out. So glad you're here, and we'll see you next time. Over and out.